Okay, well, good afternoon, good morning, good evening, depending on where you're joining us today. This is the Next Wave webinar series from GCB. We've got a lot to go through. We have a big panel and a huge number of experts on today, so I don't want to keep this part too long. But this is probably the best panel that I could have thought of to put together to talk about venture building, because every single person that we have here today has their own particular kind of flavor of looking at this. So in no particular order, Debbie Burkeen is Chief Strategy and Innovation Officer for CSAA, the California insurance company. And quite unusually, Debbie is, both Chief Strategy and Innovation Officer, combining those roles. So she's a really big believer in that kind of full toolkit for innovation. So CSAA, both invests in startups, also has built a venture called Mobilitas, which is targeted at the new area of ride sharing. And so Debbie will tell us a little bit about kind of what went on under the hood to build that. Gurdeep Singh Kohli is one of the founding members of SE Ventures, the investment arm of Standard Chartered Bank. And again, Gurdeep kind of does a bit of everything because, SE Ventures both invests in startups, but also builds its own ventures. And they've actually become so confident in doing that they now kind of co-create internal ventures with clients. And so there's a kind of evolution of that, which I'm looking forward to hearing about. And then Alex Marr is the co-founder and managing partner of Striber. Started in Germany, now offices all over the place in the Middle East, and most recently in Singapore, which is where Alex is joining us from, which is why he has a kind of midnight backdrop on his video. And again, having worked with some of the really big European companies in the beginning on this, an interesting perspective in kind of how this area is developing. Also, Alex has done a lot of research into kind of how this is developing for companies. And I'll show you some of that because I've borrowed a few slides from him. So thanks, Alex. And then last but not by any means least, Linda Yates, who's the co-founder and CEO of Mach 49, who has a new book out, which you can see in the background, A Unicorn Within, which is all about kind of how to create these internal unicorns. And I think, Linda is kind of very much a confidence builder for companies, sort of saying, yes, you can do this. And in 3 months, you can have a internal venture that has a sort of at least a very strong idea for a minimal viable product, a go-to-market plan. You can launch these, and your survival rates for an internal startup should be better than what you could get in an external one. So I think there's a strong message there. So just a few more things to go through. So I will try not to take up too much time with my exposition of this because we want to hear from our experts. But I just wanted to show you a couple of slides to set the scene. So of course, we're talking about venture building like it's some new thing, but of course it isn't. It's something that companies have done throughout the ages, and you don't have to look very far or do very deep research to find plenty of examples of companies that began as kind of offshoots, internal ventures. So Vodafone, Target, Blue, and in some of these cases, I mean, can anybody actually, anymore remember Racal Electronics, which was the parent company of Vodafone? So it has been going on for a long time. And how much does it happen now? Well, I had a kind of quick look, and this is something that companies are continuing to do. These are all examples of internally built ventures. They might not all have exactly the same look and flavor, but while none of these have necessarily become huge brands, a surprising number of these are still going quite strongly. So this was the other question that we had is kind of just how many venture builders are there out there? How many companies are doing this? And it's surprisingly difficult to find those numbers, but I borrowed this slide from Alex and from Striber, because they keep a track of sort of at least how many internal venture building programs there are in Europe. And so you can sort of see the top line there. These internal venture builders, so 35 that his team have been able to track. Sometimes it's very difficult to tell. Companies don't exactly announce this if they're beginning a program. So it's a case of some detective work, talking to people, finding out, seeing from some sort of side note. So it would be nice to track this a little bit more closely, but this is what we have at the moment. The other question was, are companies any good at building ventures? And I feel like there's kind of a lot of opinions on this one, because companies certainly haven't been brilliant at accelerators. And I appreciate that accelerators and internally built ventures are slightly different. I mean, the accelerator, often you take in an external company and you're trying to accelerate it. And the track record of those has not been amazing, because if the failure rate of of startups, the non-corporate accelerated startups, if you can see on the left-hand side of the screen there, it's pretty low anyway, with 88% failing. But if it was, corporate accelerated, the failure rate was even higher than that. And similarly, the corporate accelerator mortality rate that we've seen in this kind of CB Insights chart from a few years ago, was suggesting that this is not something that companies were terribly good at. But then when I had a quick look at my own sort of list of the ones that, had recently been started by companies, I mean, the track record doesn't seem to be terrible. There's a few that have closed, a few, one that was sold. Marcus by Goldman Sachs is frequently in the headlines at the moment because it's not doing particularly well, but I mean, it's still going, and who knows what will happen with that. But this wasn't a sort of unmitigated disaster by any means, from what I could see. It still might be early days, but I think those were just kind of some opening thoughts that I wanted to start us off with. And without further ado, I just want to go to the discussion part of this. Now, just a couple of housekeeping notes. So we'd like this session to be very much an interactive one, so please ask questions. The panel is here to kind of field questions from you. We're running a poll, which is, are you currently involved in a venture building program? And my assumption is that a lot of people who are tuning into this are actually quite interested in this, because they are involved in this, doing this at the moment, and they're looking for answers. So I'd just love to get a sense of that. And then also I'm asking, and bearing in mind, the answers are anonymous, but how is it going? If you had to rate it from 1 to 10, 1 being not good at all, 10 being the best, how is this going? Anyway, so please use the Q&A function to ask questions. There's a possibility of upvoting questions. So if somebody else has asked a question that you would really like to see answered, do upvote that, and we'll try to get along to that. And we're going to try to leave at least half of this session for that Q&A session. So we'll leave the poll running, but I'd love to just have all the panel introduce themselves. The very quick note on sort of why venture building is something that has become so popular recently. I mean, companies have been doing it for a long time, but I think it's fair to say there's been a sort of resurgence of interest around it. Why is that? Now, we're sort of not trying to convince anyone, because again, we're assuming a certain level of expertise and a certain level of involvement already. But I'd love to hear from the panel sort of, what is it that you were looking for, or that you've seen your clients looking for with this? And if we go around, if I start with you, Debbie, and then going through to Gurdeep and Alex, and then Linda.
Sure. Well, thank you very much, Maya, and hello, everyone. Great to be here. My answer to why venture building is, I am a fan of all the innovation tools in the toolbox, and that's the approach that I've taken at CSAA. But I think, building organic ventures from the inside is really important, because in my case, the company I work for is over 100 years old, and any mature, successful, large company over time has to perfect things around predictability and just operational efficiency and profitability, all of those abilities. And, somewhere along the way, they tend to focus on those and kind of lose or neglect, new organic business building. And I think every company, has to be worried about growth, and because it's about long-term viability. So that's why I think venture building is important.
Okay, back to those sort of original roots. What about you, Gurdeep? What was it that Standard Chartered was looking for this?
I think the overall agenda was transformation. In fact, many corporates talk about transformation in the context of let's do digitization, or let's create new products. But if you're serious about transformation, the leadership acknowledged that transformation is about changing the business mix and becoming I would say, different organization in the future. For that, you have to be open to disrupt not just your existing business of the bank, but also the sector, which is banking. And there was another element which was going on from a trend perspective, that the gap between banking and society, we acknowledged, was widening. And you had to take a different approach to bridge that gap. And you can do a lot of innovation. In fact, the bank continues to do a lot of innovation within its existing businesses. But we took a rather courageous move to say, no, we have to set up something distinct as a separate unit, which does new business models, not just for the bank, but also with its own clients. And we'll talk more about the journey in a minute.
Yeah. Okay. So a sort of more systemic transformation was sort of the goal there. And Alex, what are you seeing in, the clients that you work with across the board? What are they looking for?
Well, obviously, corporate venture building. Well, thanks for having me, by the way. Corporate venture building is a very new, innovative method for innovation itself. And compared to other methods, it has just some unique features that you cannot ignore. So we believe if you really want to do a serious innovation, it has to happen on the operating P&L. So that's basically EBIT line and everything above. And you get there by general accounting principles if you own 50%, more than 50% of the innovation that you're driving. Very simple. And there's only two methods that get you there. It's either you buy it or you build it. So it's very simple. Either you have an M&A move, you buy a startup, an innovation that you want to incorporate in your business. Fair, you will have to pay a fair price. But for whatever reason that doesn't go right, or it's too expensive, or maybe there's not even a deal flow that you're looking for, the only alternative here is actually building it. So from my point of view, every corporate needs to incorporate those capabilities to actually venture build sooner or later, and this is why actually we are totally dedicated to this topic.
Yeah. And Linda, what about you? What can you add to that? Because there's millions of startups that you could work with, right? So where does the attention to building come?
Well, I think 3 stats that are really important. So if you think about it, number one, if you look at the Fortune 500 50 years ago, and you look at the average life of a company on the Fortune 500 list 50 years ago, the average life was 75 years. Today, it's 15 years and declining. Of those companies on that Fortune 500 list 50 years ago, 88% of them are out of business, off the list, or completely irrelevant. So it's an imperative that people grow. In addition, if you look at the CB Insights list today, there are 1,210 unicorns. The total value of them, even today in a semi-recessionary period, is almost $4 trillion, which means that all these large companies have left a tremendous amount of money on the table, which doesn't make your shareholders happy, given that there isn't a single one of these ventures that a large company couldn't have created. And I think the third most recent and scary statistic is that Pricewaterhouse did a survey for Davos of all the CEOs. And of those CEOs, 40% of them reported that their companies will be out of business in 10 years if they do not transform. Venture building is the antidote to that. And it's actually more than just venture building. It's actually, they've got to build growth engines. And these growth engines are very much, and I think what everybody should really appreciate about GCVI and for them putting this on is because they're now focusing, they've obviously been always focused on the venture investing, which is very important. Venture investing, strategic partnering, targeted M&A, very important. But the fourth leg of that growth engine, the fourth pillar of that growth engine is the organic venture building. And there's a whole bunch of other reasons. And I think now is the moment. I just did a interview with the Financial Times that got published this morning, where she was writing an article on the revenge of the incumbents, which I absolutely love. Absolutely love. And they interviewed one of your own, GCV's own, Conviviality Ventures, with Stéphane Languet, for that article. And she said, why is now the right time? People have been trying it. There have not been great results. Why is it now that you're seeing such an upswell in this? And I think, two big things drove it. COVID drove it. because a lot of people had been basically checking the box for their board, doing jazz hands around, oh yeah, digital transformation, we've been doing it. And then COVID hit and they got caught with their pants down and really hadn't been doing anything. And then the second thing is, I believe this big push to ESG. I really do believe that people are finally taking the issue of sustainability and climate change and their ability, that large companies, we need them to lean in, to innovate, to disrupt, to experiment, to change the world, and to solve these big, hairy problems. And I think the CEOs of the biggest companies around the world are taking that seriously, and venture building is one of the answers.
Yep. Okay, I think all good answers. So I'd love to jump into the kind of nitty gritty of it now. And starting with you, Debbie, because you've kind of very recently come out of the, well, you're still in it, but the experience of building Mobilitas, which was, you know, is doing really well. I mean, it started as, I guess, kind of like a small project and is now kind of, you know, contributing to the corporate bottom line, right? So and look, like the reason that you're on this panel and, you know, Gurdeep is on this panel is because you guys have been successful at creating these internal ventures, but you know, I'd love to kind of see the little legs of the duck or the swan kind of, you know, paddling underneath the water. Like it maybe it looks good on the surface, but what kind of went into making this work? You know, what are some of those pitfalls that you had to kind of negotiate around?
Yeah, thank you. Well, that's a good analogy, like the calm duck above it's visible from the surface of the water and what's going on underneath. So a little bit of context, I was hired in a newly created role by a 100-year-old company, CSAA, about $4 billion in revenues at the time, personal lines insured, to create $1 billion in new revenue outside of the core business in a 10-year period. So just to remind the numbers, right? $4 billion company creating $1 billion in new revenue in 10 years. So the good thing about this audacious goal was there was a goal. So there was some commitment on the part of the leadership team and the board and the creation of the role that I ended up getting. But definitely no small task. So the kind of super rosy Goldilocks view is at 100,000 feet, right? At 6 years in, we have now built from scratch a commercial insurance company called Mobilitas that's focused on the sharing economy, as Maya said earlier. And we don't report we're not a publicly traded company. We don't report our revenues externally, but we are legitimately on our way to meeting that goal. And we've been in market for 4 years, which is, I've been trying to do this corporate innovation thing for probably close to 20 years. And I can't tell you how happy I am that we've had this success to date. And, you know, maybe it sounds easy peasy. You set a goal, you execute, you get support from the board and the CEO, and it just happens. Not true. I would say it's not just the little feet paddling underneath the surface of the water. You know, the reality has been kind of all over the map. At times it was a slog getting buy-in. You know, I had some of my own peers like, you know, why would we go into commercial? We don't have any experience there. We've been for over 100 years selling personal auto and home to one set of customers, AAA members through one channel, AAA retail centers. And, you know, so there was a little bit of, how do we do this? We don't have that expertise. Although 50%, more than 50% of our book was in personal auto. So there was some leverageable expertise on that side. There were epic battles and fights in a way that, you know, closer that we got to, you know, there's certain things you have to do in insurance. You have to file for a certificate of authority. You know, you create the company, you got to get licensed in every state. There's different ways to be licensed. It's very complex. It's been a fun learning journey for me. But, you know, different points along the path in the early days before we even had a product and we're close to being in market, it was just really a lot of persistence and not giving up and, you know, just making the case and making the case again. Why are we doing this? You know, for the sake of what are we doing this? Because we need to strategically diversify. At that time, this is like 2016 through 2017, we thought autonomous vehicles were coming faster than they have, you know, and the sharing economy was already on our doorsteps. Millennials and Gen Zs were predicted to not want to buy large assets, and the fundamental business model for insurance is kind of anchored to ownership of a large asset, whether it's your home or your car. So, there were very good defensive reasons to start this business but I can get into the gory details if folks want to know, but the long and short of it is it was a long process. And some of the challenges were actually too much help. I know I've heard Linda talk about this, and I've talked about this too. Sometimes corporates want to like suffocate their exciting new little baby ventures because it's so cute and we love you to death. It's like, no, I don't really need that help right now.
Yeah.
Too much help is also not helpful.
And I think we can dive into some of those, but just two really quick questions was, so did you had a dedicated budget to this, and did you manage to kind of defend that throughout? So was that never in question?
I was building two things. I was attempting to build two things at the same time, right? I went in, I wish I'd had Linda's book when I started, but I had learned through the School of Hard Knocks and doing innovation at Citi and HP previously, that I had a vision for building an always on kind of repeatable growth engine. So like a venture building factory that Linda talks about. And I was trying to build the foundational elements of that while simultaneously realizing we need to diversify into commercial for strategic and competitive reasons. So doing both at the same time. So I did set up a separate funding mechanism and a separate, we call it the growth board. It's really the leadership team of the company, but it's sort of like, look, in this room, you're wearing a different hat. You're more like venture investors. And we're talking about strategic bets on our future. And the growth board funds sit in my budget still to this day, but I don't spend them without full transparency and visibility and buy-in from the growth board. So yes, but that was the least of the challenge, to be perfectly honest. It's really more, can we really do this? Why would we do this? How can we do it if we don't have the expertise? Well, you can actually hire people who have this expertise, So.
Well, let's keep it bouncing around, because I'd love to I'll come back to this with questions, but would love to hear from you, Gurdeep, because was it a similar journey to you've done several ventures now, so it really has been kind of some of that venture factory type operation. How smooth was that sort of process?
Oh, smooth is not the word I would use. Obviously, you will hear a lot of that sentiment being echoed. I mean, the message for the 150 people who are listening, it's exciting, but not smooth. It's challenging. Corporate venture building is hard. We are 5 years old now. And I think everybody was talking about in the context of how old these organizations are. So Standard Chartered Bank is a 160-year-old organization. And for that organization to take a leap to say, let's do something very different from what we had not tried in the past. 5 years old, we started this business unit. And I'm going to borrow a few statements from some of my colleagues here, which is objectives were broadly threefold, right? Which is drive the innovation culture in the bank, because the bank obviously realized that you can't just say, this is a unit on the side, let's just play with it, or culture change will happen on its own. And then the second is, to Linda's point, many corporates have a CVC or a fund, but they may not necessarily have a venture building activity. So the second objective is to invest in fintechs with whom we work. And that is our fund, bluntly put. And then the third activity, which is close to my heart, is the venture building activity. So these were the three things we put together. We were very clear that unless you do the venture building activity, you don't generate that excitement in the organization. So if you really want culture change, you have to do something more real and challenging. Otherwise, bluntly speaking, it becomes a bit of a theater, which is what I would say SC Venture was very clear about, to put it that way. Then 5 years, a lot of lessons learned. We have come a long way and we're still learning. I have to say we're still learning. We have a portfolio of 30 ventures. We have taken a slightly different approach, as you said, created a portfolio of ventures across 4 different themes: digital, banking and lifestyle, SMEs and world trade, digital assets, and then sustainability and inclusion. Across these 4 themes, 30 ventures, but 10 have been now announced and launched. And we are, I would say, on path to create a more diversified portfolio with the aspiration to contribute to the transformation agenda of the bank, but also rewire the DNA in banking. Now, the one thing which I want to be very clear that many people also talk about venture building. And when you scratch the surface and say, what do you mean by it? You learn a lot, which is, oh, that's not venture. when we say venture, we actually are talking about separate subsidiaries, legal entities with under a different brand. So you can see on the website, different ventures, they have a different brand, and the ESOP is also embedded for the venture teams. All these things, by the way, to your point about Smooth, to negotiate all these things with the mothership, and to give credit to the mothership for allowing you to this freedom, but it's a negotiation.
Yeah.
Which is, you're attached to your brand. I want a different color. I want a different name. I don't want to say always for all ventures powered by the bank, and so on and so forth. So it's a long journey, and obviously, not to be covered in this short topic today, but we can have part 2 as we were discussing. I think sorry, go ahead.
Yeah, so it's just a super quick question, because having were there other teams that are creating these, your 4 sort of separate teams, are they mostly staffed with people that you've hired from the outside, or did you have a mix of people from inside the bank? And because you're talking about the cultural change agenda as well, so how do you balance that?
So absolutely, has to be a mix, because if you only rely on changing the DNA of the people who are within the bank, and by the way, I believe there is an intrapreneur and an entrepreneur hidden in most people, you just need to give them a platform. But then you also have to inject the DNA of, frankly, innovation and experimentation and the risk mindset, which is, frankly, if you are spending a lot of time in a large organization, you become a bit risk averse. So you have to infuse that DNA, whether it is tech or innovation, or frankly, just breaking some boundaries. So short answer is, it's a mix of both within and outside.
Yeah. Now, again, I'm going to keep this bouncing around and also I think it might be a good time actually to start turning to the questions, because this one is perfect for you, Alex, and then for Linda. This question from Fabrizia, which is, how do you know that a corporate is prepared for a corporate venture builder? And that must be absolutely the first question that you're kind of confronted with when you're dealing with a new client. So I just wondered if you had thoughts, Alex, on what are you looking for in readiness?
Well, that's a very difficult question, I believe, because again, I said earlier that everyone should do it. So the question is, when is the timing right to actually get started? And the answer must be anytime. Because there are so many problems with venture building, so many headaches that you will create, as Gurdeep just outlined very well, that you cannot be ready, you cannot be 100% prepared to what's coming at you, but you have to set this up in a very agile, lean, and evolving way. Just to start somewhere, building conviction with your stakeholders, showing that there is some results, then asking for more, and step by step getting into a situation where you can unlock larger budgets in order to actually do the real stuff. And from my point of view, that would be building that venture studio, that growth engine, that venture factory we are talking about, because that means that you have enough budget and freedom that you can actually internalize these venture building capabilities that are so important for corporates from various aspects, being it cultural, being it as I explained earlier, purely financial and innovation driven. So my suggestion just would be, take a swing at it, start small, build conviction, and then make it as big as it has to be. For example, 1 billion in additional revenue in 10 years, which is an excellent audacious goal. I'm happy to hear that. We hear that a lot in that kind of dimension. And maybe a short hint, what kind of dimension is important for your mothership company. Our learning is that you should at least reach 10% of what you're doing today. So 1 billion over 4 was already 25%, which is very audacious. But typically, our clients and many of the corporates out there have more like at least 10%, and even more. That's great, because that's the kind of threshold that you cannot reach with a simple cost-cutting exercise. There is real innovation beyond 10% of what you have right now.
So would you
just
say,
go for it?
Yeah. So if they're not going for at least 10%, they're not setting their sights kind of ambitiously enough, I guess.
Exactly. That will not draw the attention of the management, because if you just show 1% improvement over 10 years with a lot of risk and investment, nobody will look at this as an opportunity.
Yeah. Okay, I'd love to turn to you, Linda, because do you agree broadly, or are there kind of readiness criteria that you have?
So where I agree completely with Alex is that I think people should start small. And by the way, Debbie's being extraordinarily humble. She is absolutely the poster child. She's been doing this longer than anybody else in frankly the world, and had more success than almost anyone. So I'm thrilled that she's reading it, but she, we could have all taken lessons from her as well. So I mean, I really believe that, and kind of what they've achieved has been amazing. And I think Standard Chartered is coming right behind them. So I do believe that we always tell people you got to start with one, and you've got to start small, and then you build from there. But we are doing another big piece of research that we're about to publish and launch, which is about this issue of what's the prequel to growth, because not everybody is ready to grow. And so we actually have a self-assessment tool that we're building. We're building a digital platform to basically take everything we have and kind of democratize what we do. But one of the things that we are doing with clients is, and frankly, it was some of our experience in Singapore that really drove us to this, which is, are you ready to grow? And, do you have, and the whole thing is this, we have what we call growth readiness assessment. And it asks questions like, are you inspired by the voice of the customer? Because if all you are is a group of people who basically think you know everything, and you're never going to talk to customers, then you are never going to be successful doing this. Are you current on the disruptors at the gate, right? So have you done ecosystem maps? Do you know who the startups are that are out there? Do you know where the money is coming from, PE or venture capital or other CVCs, or who you're going to be competing with? Do you have strategic assets to leverage? We do what we call an asset jam with people. What are the core competencies, assets, capabilities? How do you seize the mothership advantage to actually help your ventures thrive? And can you basically grab all those people to make that happen? And we'll talk later, when you talk about team, about a very important group that everybody forgets about in the rest of the organization that needs to be created, which is what we call new venture advocates. Do you favor agility over friction? And we're doing this research with Huggy Rao, who's the professor at Stanford School of Business, who wrote the book Scaling Up Excellence, because you really have to, it's more than just the venture building. That's almost the easy part. It's really, what are you doing with the rest of the organization to seize it? Can you unleash your people and capital, right? This is one of the challenges that when we find people, if you basically tell me you're an $11 billion company, you can't free up 4 people for 12 weeks to work on venture building full time, you're not serious, you can't be successful. And so, there are preconditions for success that are really important. Otherwise, they shouldn't start. They should fill those gaps, close those gaps. Once then they basically know for sure that they're ready to grow, and many of them are, to Alex's point, many of them should just start. But then they need to build their growth engine, right? But you've got to make sure that they're ready, because otherwise people are going to be beating their heads against the wall. The people who are really excited about it are all going to leave, and the corporates will have wasted a lot of money. And they just don't have the ability to waste money, especially the multi-billion-dollar multinational public ones. CSAA is a different, but they still do have to make money, right? They're not wedded to what the financial markets say, and we'll come back to that as well. But they still do have to make money. So I believe that there are preconditions for success, and I think people can do self-assessment and they can figure it out and then go from there.
Okay. All right. So there's going through some of these questions. I think there's a really interesting one from Maria Morfin, which I wonder whether we could knock on the head. But this is one about internal venture builders versus collaborating with an external one. And I might kind of pick on you, Gurdeep, to begin us off on this one, because there are a lot of good external venture builders out there who will do things for you. So what's the advantage of doing it sort of in-house?
So just so that I don't misunderstand the question, the mandate is to build ventures, and we are absolutely open to build ventures with external venture building partners and using the ecosystem and the knowledge available. So in fact, the people on the call, they do know we have engaged them on collaboration opportunities already. So let's not confuse, you have to own the client problem. You have to be very clear about what is the space where you bring, I think the phrase used is, your unfair advantage to that problem, and what is the ecosystem you can connect. But when it comes to venture building methodology, I would highly recommend working with some of the names on the screen right now.
Yeah. And I think, you know, going to you as well, Alex, I mean, again, you can build ventures, I guess, for people, but you're also very much of the philosophy of, you know, teach a man to fish so that he can do this himself, and building that internal capability. How do you sort of talk clients through that decision process, how they want to approach that?
I think you can be, I don't want to say lucky, but I really do believe that a one-shot, like a kind of a focus on only one venture could potentially fail, since there's a likelihood of failure to every venture. That's also true for corporates, right? So if that succeeds, that's great. But in order to hedge that risk, it's very advisable to actually build a number of ventures, a portfolio of ventures. And then double down on the winners, right? You might end up with one real big business unit out of this. But in order to get there, in order to see what's really working, you should probably start a few of them. Now, that's what we call a portfolio. And in order to get there, it's probably quite expensive to engage either Linda or myself for every single one of them. So basically, if you want to have a financial return on this portfolio, it's just better to, over time, internalize these capabilities. And that's what we are working on with all of our clients. We want them to really internalize and have a venture studio design internally that really makes sense for them. It doesn't mean that they build everything themselves, depending on how many ventures they want to build, or kind of what kind of is the output number that we are going after. There might be an extended workbench set up. There might be, choosing us or other venture builders to have some expertise in fintech or whatnot, and then just build internally what you actually can build and make sense to build internally. Yeah. So the more you internalize, I think, the better it is for you in the long run, not only for financial perspectives, but also for that cultural change that we keep talking about, and just frankly, being customer driven and innovative as a company. So all of that are benefits from internalizing, and I'm a strong advocate for that.
Now, there's some other interesting, and please do keep your questions coming, but I thought there was one that we could turn to, which Debbie and Linda, I'd love to hear your views on this, but this is this question from Miguel, which is, what are the specific traits or characteristics that corporate ventures have in common with founder-led counterparts? And specifically, how do you kind of replicate that founder drive? And I don't know whether, Debbie, you're smiling because, and I'd love to start with you, but then get Linda's perspective on this as well. Like, how do you, when you're doing this with people who are maybe, was your team sort of similarly to Gurdeep, sort of half and half from internally and externally, and how did you manage to get them to have that kind of passion and fire to drive it through?
Yeah, as I think it's a great question. As I mentioned, I'm sort of trying to build up my new organization somewhat in parallel with starting the Mobilitas venture. So even before we had the Mobilitas name. So we were pursuing Mobilitas as a venture building activity, starting with just my team, which at the time was primarily people from the business. But I've learned over the years, especially from the work I did at Citi, and Lean Startup was kind of in vogue at that time. And, I think the good news about, Eric talks about this, and actually we worked with Eric at Citi, a lot of the principles of Lean Startup and creating new ventures out, in startup ecosystem externally and internally, a lot of those things can be learned. I mean, honestly, I think Linda's book is fantastic. I wish I had it 20 years ago. But I think the hard thing about internal founders, the big difference is, I don't know. I've worked for startups too. I've mostly worked at corporates, but I spent a few years in the startup ecosystem, venture-backed startups. So I've been on both sides. And I think the beauty of the startups in the wild is like this, a lot of insurtech. So in my industry, a lot of external startups don't have experience in insurance. They ultimately at some point hire somebody who has that. But what they do have is experience as a consumer usually. And like just this laser focused insight of like, that's stupid. Why do they do it that way? That's a really bad customer experience. And they're brilliant at targeting those things. And it sort of shows you where the industry needs to go. Those things, you know, internally, the conversation is like, oh yeah, I tried to fix that forever. It's really hard. It just becomes this accepted friction point that over time companies lose passion or energy to fix. So, but I think, you know, what we did, I did whatever I could to make sure that Mobilitas had a chance to survive, to have the possibility to get some traction in the market and ultimately grow. And luck was definitely involved. There was a CEO change kind of right around the time we were launching, and I could not have been luckier in terms of who became our CEO. He was totally bought into the vision and the need to diversify into commercial, and that really helped us. And, you know, I hate to think about what the outcome might have been if we hadn't had that, you know, but fortune, favors the prepared, as they say. So you put everything in place. But I think, you know, I do think you're looking for whether the talent comes from the inside and is taught, or the talent is, you know, you're leveraging talent and expertise from the externally. You've got to have people who've got the fortitude to believe in a vision, sell the vision, and not get thrown off track by all the antibodies, you know, challenges, fights, stuff that will come at you when you're trying to build this thing internally. Even when you have put all the right stuff in place, the preconditions, I think stuff still happens. So yeah.
Now, Linda's nodding a lot, so I want to give you a chance, because your book really goes through quite specifically sort of how people can get that into that founder mentality. But I just wondered how do you sort of get companies to make sure that they get that focus, passion, all those things?
Yeah. So, well, first of all, that, you know, the number one thing is you can't appoint somebody to do venture building, because you run the risk of what we call the passionless founder. You just can't do it. And it's one of the things I want to, you know, follow on, you know, Maria's question leads into Miguel's question that Alex was answering. Like, one of the challenges for outside venture builders, if you just outsource it and you don't include anybody internally, right, is that most of them do not understand the boardrooms and C-suites of the Global 1000. And so they cannot make that translation. And so they're just basically really good at doing startups. That's great, but they can't make that translation. Part of the reason why 100% we are here to build capability, not dependency, and find those internal entrepreneurs is because they are passionate about the company. And if you have selected them correctly or identified them correctly, they are also passionate about the concept of venture building. And that's really, really important. You know, we talked about the two reasons the altruistic reasons we founded Mach 49. One of them we've talked about, which is that big companies can change the world and have to address these big, hairy problems. The other is that people are living longer and longer because of healthcare and technology. And they are going to work 60, 70, 80 years. That means they need meaningful, purposeful work. And while we all love startups, right, most people are employed by large companies. And so CHROs absolutely love us because they are 100%, they're focusing on recruiting and retention, and how do they create opportunities for people to be more closer to the customer, more agile, more responsive, kill things faster. So these large companies need to look more like Berkshire Hathaway, be more like a portfolio of companies than they are just these monoliths. And that gives their people opportunities. Those people that they're giving opportunities, what we need to realize is that there's room for everyone. Not everybody is meant to be an entrepreneur, right? Some of these people are amazing. They love the ambiguity. They love the lack of structure. They love to talk to customers. They love the pace. They love all of it. But at some point, those people actually need to pass off to what we call the growth geniuses, the people who, in essence, can grow something 20, 30, 40% a year, put the systems and processes in place. They don't like the early stage. And the early stage people who are inside your company don't love this stage as it's starting to get more codified. And ultimately, both those guys pass off to what we call the efficiency experts. Those are the people who know how to run and scale large businesses, spin off the operating, you know, manage the operations to spin it off to basically restore the cycle. And so the reality is that those people exist in every single organization. And these internal ventures don't look that different from a regular startup, except for two things. Number one, they actually have this incredible advantage over any well-funded startup because there's ideas, talent, brand, channels, customers. I talked to one brand new CEO of a very large European auto company, and he said to me, Linda, you know, you know everybody in Silicon Valley. You can help me navigate. How much money do I have to put in a fund? Is it 50 million euro? Is it 100 million euro? I said, it's that much. He said, what do you mean? All my people are saying I have to put so much money. I said, Silicon Valley doesn't need your money. How many customers do you have? He said 30 million. I said, okay, let's start there, right? That's what you guys have. And that's what the people inside can bring. Now, yes, sometimes you have to augment. When we did a work with a big investment bank in South Africa, they had an amazing group of team. They were forever going to be the founders, but they were all investment bankers building a digital platform. They didn't know how to build a digital platform, bring it to scale. So we had to bring in a CEO from the outside, but they were still founders. And that's the other thing that's super important. And we talk to people all the time about, which is, how are you going to do compensation? How are you going to compensate your venture team? So it's not just about them having passion. You already compensate salespeople for performance. There is no reason you can't compensate internal venture founders or venture factory team members or CVC team members for achieving goals. So it's we have a tool that literally is, how do you select a great venture team? Because two things kill a venture, right? Toxic team members and no market. And so you have to do a lot of work there. But there's so many people inside these large companies that are just passionate and want to be unleashed and be able to do this. There's no problem being able to find them.
Yeah, that sharing the upside is a really tricky question. I think we should, if we've got time, we can come back to that. But I do want to get through some of these, because I think there's a couple of interestingly linked questions here, which is, there's one about, sort of from Michael McDermott, what investment criteria did you believe was important at one time, but no longer think is important in evaluating new ventures? And there was a kind of related question to Debbie, but I think could apply to all, what's kind of changed in, the time you've been doing this, that you've learned. So I feel like both of these questions are really asking about kind of what have you been able to sort of shed along the wayside as you've been going through this. And I if I can bring you in, Gurdeep, to this is really about kind of what have you learned that's really necessary and what's not necessary? Have you jettisoned some working practices as you've been doing this?
I can definitely share one concrete example, which is we realized that we should build ventures with the ecosystem partners. I think the temptation to do it everything on your own is not a good idea. Let me give some examples to illustrate this. Actually, as a corporate venture, the advantage we are talking about is what's the advantage of the corporate. But one of the advantage of a corporate is the corporate relationships. And what we realize is that the problem statements or the themes we are tackling resonate with most of, if not all of the corporates, whether it is SME, supply chain, you talk about digital assets. A lot of people are still figuring out what to do with it. And then you talk about sustainability and inclusion. There is no client engagement conversation which does not touch one of these themes, which is, oh, is that a problem you're trying to solve? That's also a problem which I am trying to solve. And then you say, let's do the co-creation. So one of the significant shifts we have made is starting to co-create ventures with our corporate partners. And actually, that has a lot of advantages. It is not just about bringing the client's own advantage, but actually the power of the client's ecosystem. Imagine you're talking about one corporate and its supply chain, and you talk about another corporate and its supply chain. You're talking about millions already before you have even started in terms of what you can do in terms of impact. I think the second thing which people do not acknowledge is that we also changed our mindset. When we started venture building, we brought people from inside and outside. You will hear this a lot. Nobody enjoys building a corporate within a corporate. I'm talking about not just a bank, but any corporate, because people would say, it's very hard. It's very difficult to make decisions. Why do I need so much governance? Actually, if I was in a garage, I wouldn't have answered any of these questions about security, risk, compliance. Guess what? That is actually your advantage, which you don't realize. It's an upfront cost. It is painful. But once you go to the market and you try to bring other corporates, I was in a conversation without taking names about a potential venture, and it was still at an ideation stage. And the person on the other side, I said, okay, what do you want to see about this venture for you to be interested, whether you want to partner or not? First word, I would love to understand your corporate governance and how you are thinking about information security. And I smiled And the venture team sitting there, they looked at me and I said, see, I told you so. You were complaining all the while, which is why I'm making you go through this corporate governance. And actually, it's an advantage. So these are two reflections which I can pass with the audience today, share with the audience today.
Okay. No, I think good advice. Yes, definitely. I've heard a lot of ventures who've worked with, had to work very closely with a corporate and have had to go through that painful experience, then saying that they came out of that much more market ready at the, even though they weren't necessarily even internal corporate built ventures, but if they just had that relationship and they had to do that work, it's always useful. Alex, I'd love to bring you in. If we're still on this question of kind of learnings that have come, again, you work with multiple companies, you're trying to steer them through this as best you can. I'm just wondering whether over the years you've sort of evolved your sort of advice and methodology a little bit.
Well, of course, right? So I always claim that we never stop learning. With every new client, with every new project, we're still learning, although we are 7 years into the business now. Also very interesting, I think, is the difference in different markets. So I think the maturity or the penetration of venture building to be known is very different in Europe, in the Middle East, and Asia Pacific, where we are operating. So in the early days, I think it was most about setting up more of a strategic problem, right? Like, how many ventures do we need to build? How do we build this? How do we set up the governance? And now, since many organizations are incorporating this already, many have, since 2 or 3 years, venture building operations internalized. It's also about, heck, what do we do actually when a venture works, right? So we haven't thought about, the venture is successful, and how do we portfolio manage these ventures and develop them to a Series B, a Series C? That was a problem that was not existing 5 years ago in corporate venture building. So of course, these problems evolve from more strategic problems and early stage ideation problems to now it's more operational efficiency in venture studios and actually managing a portfolio towards the ROI that was promised 5 years ago. So I think it's just a very exciting space to be in, and I hope I will never stop learning, and I think the business proves me right so far.
Yeah, you've actually started answering a question, Alejandro's question as well, which was this one about, how should corporate venture builders balance their activities between creating new ventures and scaling the ones that have already launched. And I think it would be interesting to talk for a few moments about that kind of what happens when you succeed. We worry so much about just getting the thing off the ground, but when it starts to take off, and I don't know if you have any further thoughts on that, Alex, like, how do you just have to have a separate team that then now you can hand this over to? And
yeah, so typically what we see in internal venture building organizations, venture studios or similar, is that this problem haven't been thought about, and therefore there's no role or capacity to actually portfolio manage these companies. But maybe the mothership company has other teams that could take care of. For example, corporate venture capital teams that are very, very savvy in portfolio managing early stage or either later stage startups. What you shouldn't do, basically, because I don't think that's the right way, is actually giving it to participation management that actually, manage M&A deals and have that super late stage, highly profitable kind of assets. That's not where a startup should be positioned and be portfolio managed. What I feel like is that corporates still have a little bit of a hesitation to really do portfolio management actively. So meaning, merge, if it doesn't work out, sell it away, merge it with something else, shut it down, what have you. And, the logo slide that you showed, I'm sure some of these logos are not existing anymore and nobody talks about it, right? So it's kind of that silence about it, and it's weird, nothing is going on, but also portfolio management value is destroyed here. So I think there's a lot to learn from the venture capital world in this respect. And yeah, a lot of value also to be created there.
Yeah, and I think there's also, this leads on to an interesting point, maybe you can pick up from here, Linda, but that's sort of the way that the different parts of your innovation toolkit work together. There's a question that we had here about whether there's any tension between, you know, corporate venture building and corporate venture investing. And how do you sort of advise companies to bring those two to work nicely together?
Yeah. So number one is, yes, there is at times, and it needs to go away, right? There are some venture investing groups that can't stand the internal venture builders and vice versa, and they should all get canned, and you should bring in a new group because they have to work together. And to Alex's point, the whole concept of being able to get to a portfolio is very important. You cannot just build one venture. No venture capitalist invests in one venture. And don't kid yourselves, right? Yes, there are a lot of value that comes from these ventures, but you, in the end, must drive growth and you must have financial impact. To have financial impact, you've got to get to a portfolio just like a VC does. And when you get to a portfolio, then you will have, you know, your 2 winners, your 3, you know, kind of first base, second base, third base, and then you're going to have those that you kill, and you must get disciplined about killing them. And so that portfolio is really important. And to do that, we're doing a lot of kind of advanced work around financial engineering to help people actually do this off their balance sheet and not have to consolidate them in the P&L. And we're doing a lot of work with the financial markets on how we value these unicorns within. Because guess what? They know how to value startups. They'll give a startup a hall pass for 4 to 5 years with a set of metrics that they already are using that gets a 15x multiple that the same venture inside of a large company isn't getting. So we're going after those guys as well. But, you know, the reality is we have, you know, incubated hundreds of ventures. They're actually many of them are doing incredibly well. We've designed 25 new CVCs from big industrial companies. They don't have to be consumer packaged goods company. It could be Schneider Electric. It could be Hitachi. It could be, we built the emerging growth and incubation division for Intel. And so to this point about what you do with these ventures, you know, we're talking a lot with people about creating growth divisions, even beyond venture factories, for this reason that you can keep the metrics separate. So at least when the financial markets look at you, they blend the valuations. They don't just send your ventures through a quarterly, set of metrics that are relevant to your core and legacy business, but have no relevance to how a startup should be measured and how the financial markets know how to do that. So, you know, it's happening. And these companies are doing a really, really good job, and they're getting to the point where they're starting to do this at scale. And those that have CVCs are now looking, TDK is a great example, started out with TDK Ventures, now doing TDK Kindergarten, right? You've got people that are basically, or they're starting out with an incubator like a Xerox, and then they're building Xerox Ventures. So more and more people are understanding that this is the yin and the yang of each other, and that there really doesn't need to be friction, because you must do all 4 things. You've got to do venture building, venture investing, strategic partnering, and what we call targeted M&A, which is not the big corp dev M&A, but this is a beauty for those of you in large companies. You have a lot of cash on your balance sheet. So you can take a venture, and if you're smart and you've done your ecosystem mapping well and you know who's out there, you can take your venture, you can accelerate or augment that venture with an acquisition that could get you. We had one for a very large industrial company. We could get them to 50 million in revenue very quickly. Guess what? That's a unicorn in Silicon Valley, but it doesn't move the needle on a $40 billion company. But we can get them to $1 billion in valuation with $100 million acquisition. That's the scale you have to be aspiring to.
Yeah. I think you've actually neatly answered another question that was a bit further down on this list, which is, would M&A activity help accelerate, you know, internal venture building? I think that's a resounding yes. But it, you know, sounds like
Done well.
But do targeted, you know, very well researched, right? Now, there are a ton of questions. I've got to apologize because there is no way we can get onto all of these, but it's a good signal to us that this was a good topic. And it means that we can take some of these questions and maybe look at whether we can do more around this. If people are interested in another webinar on venture, you know, another kind of maybe a slice of venture building, just let us know.
And Maha, we're going to be at GCVI. If any of these people are coming to GCVI, you guys are setting up pop-up, you know, sessions. We can always do a continuing Q&A session in Monterey, just purely Q&A.
Yep, exactly. So
people just let us know. We're happy to host that.
We're very much about the two-way conversation. So if you kind of enjoyed this session but felt like you didn't quite get what you completely what you wanted, let us know, and then we can see if there are ways in which we can sort of help fill in some of those blanks and do a bit more. So I am going to now just kind of, I'm afraid we just have to bring the session to a close. So I'm going to thank all the panelists. So Alex, Linda, Gurdeep, Debbie, thank you so much. I feel like we barely scratched the surface, but I hope that was useful to people. And then the next webinar will be on March the 8th. This is another topic that I think will be very useful to people in this climate. This is about navigating the downturn, especially with portfolio companies. So how do you manage your portfolio companies at this time when everybody's all about conserving, the cash, and how do you navigate a down round? That should be quite interesting. And then we have various forthcoming events. So we've mentioned the GCBI Summit, which is in Monterey, the 15th of March, 15th and 16th. Then we have an event in London. So if you are on this side of the Atlantic, think about marking your calendar for that June event. And then we also have various smaller events that happen kind of around the world at various times. So if California and London are not convenient to you, hopefully one of these other ones will be in the right geographic zone. So we'd love to see you there. There are also, if you really want a very deep dive into all of these, think about one of our GCB Institute programs where you can get kind of 2 days of tuition, very, very hands-on from people who have done this before and who can take you through that. And I think that is it. I'm sorry we've gone a little bit over, but thanks everybody for joining. And yeah, please do just sort of get in touch with me to let me know if there was something in particular about venture building that you'd like us to come back to. And thanks again for all the panel.